Today, we are going to lay the groundwork for understanding the stock market. Whether you're completely new to investing or just looking to strengthen your foundation, this session will give you the tools to start thinking like an informed investor. Here's what we'll cover today. First, we'll start with the basics. What are stocks? We'll explore how stocks work, why companies issue them, and how they play a critical role in the financial market. Next, we'll dive into what drives stock prices. We'll break this down so you can understand the key drivers behind price movement. Then, we'll look at how stock markets and indices work. We'll explain how these systems operate and why they're important for investors. Finally, we'll talk about how you can grow your wealth through stocks. There are two main ways to earn returns. Capital appreciation, when the stock price increases and you sell it for a profit, and dividends, when companies share a portion of their profits with stakeholders. We'll explore how this works and why they're key to building long-term wealth. Let's start with the basics. What exactly is the stock market? Think of it as a giant marketplace, like a supermarket. But instead of groceries, it's filled with companies. The stock market is where people buy and sell shares of publicly listed companies. These shares represent ownership in those businesses. So when you buy a share, you're essentially buying a small piece of that company. Here's the exciting part. The stock market is open every day, and companies are on sale at different prices. Just like you might shop for the best deals at a supermarket, you can shop for shares of some of the greatest companies in the world. It's an opportunity to own a piece of successful businesses without the risk, hassle, or stress of starting your own company from scratch. For example, let's say you're an employee working a 9-to-5 job. The stock market allows you to still enjoy the benefits of being a business owner. You can invest in companies you believe in, participate in their growth, and share in their profits through dividends or capital gains. It's like being both an employee and an owner at the same time. The beauty of the stock market is that it gives everyone access to ownership. Whether you're buying one share or 100, you're stepping into the world of investing and taking part in the success of businesses that drive the economy. It's a powerful way to grow your wealth over time while staying connected to the companies shaping the future. The stock market is where you can buy and sell ownership in companies, giving you the chance to grow your money and participate in the success of businesses, all without the need to start your own. It's a tool for building wealth, and it's open to anyone willing to learn and take that first step. What does it mean to own a share? When you own a share, you're essentially owning a piece of a business. Think of it as having a small stake in a money-making machine. It's like owning a part of the company, and with that comes certain rights. For example, if a company has 100 million shares and you own 1 million of them, congratulations, you own 1% of that company. You're entitled to 1% of the profits. Depending on the type of shares that you purchase, you may also get 1% of the voting power when it comes to important company decisions. It's a small piece, but it's your piece, and it ties you directly to the success of that business. Now, here's an interesting point. In the US, there's no minimum number of shares you need to buy. You can start with just one share, or even fractional shares with certain brokers. But in many Asian stock markets, it's a bit different. They have what's called a lot size. That means you might need to buy a minimum of 100 to 500 shares at a time, depending on the exchange. At the end of the day, owning shares is about being a part of a company's journey. You're investing in its growth, its profits, and its future. It's about putting your money to work in a business you believe in. And that's a pretty powerful thing. Now, let's talk about how the stock market works at its most basic level. For every trade that happens in the market, there's always a buyer and a seller. It's a simple concept, but it's the foundation of how the market operates. Now, here's the interesting part. Buyers and sellers don't agree on where prices are going. That's why trades happen in the first place. A buyer steps in because they believe the price of a stock will go up. They're optimistic about the future. This is what we call being bullish. On the other hand, a seller thinks the price is going to go down. They're more pessimistic. This is what we call being bearish. So, in every transaction, you have two opposing views. The buyer is assuming the stock will go up, bullish, and the seller is assuming the stock will go down, bearish. This constant difference in opinion is what makes the market so dynamic. In the short term, no one can agree on where prices are headed. Some people think the stock is undervalued and will rise, while others think it's overvalued and will fall. That's why prices fluctuate so much, because the market is essentially a tug of war between the bulls and the bears. This difference in opinion is what creates opportunities. As an investor, your job is to cut through the noise. Focus on the fundamentals and make decisions based on your own analysis, not just what the bulls or bears are saying. Remember, every trade has two sides. The market thrives on differing opinions. Whether you're bullish or bearish, the important thing is to stay informed and make decisions that align with your goals. Now, let's address a common myth that many people believe when they first start investing. The idea that experts can predict where the stock market is going. It's tempting to think that someone out there, whether it's a Wall Street analyst, a financial guru, or even a famous investor, has the ability to consistently and accurately predict short-term stock prices. But here's the truth. No one can predict short-term stock prices with certainty. Why is that? Well, the stock market is incredibly complex. Prices are influenced by countless factors: economic data, company performance, global events, investor sentiment, and even unexpected news. These variables interact in ways that are impossible to fully predict. In fact, academics often refer to this as the random walk theory, which suggests that short-term price movements are essentially random. Even the so-called experts have a poor track record when it comes to forecasting. Over a 20-year period, studies have shown that Wall Street analysts consistently fail to predict market movements with accuracy. Why? Because stock prices are constantly adjusting to new information, and that information is unpredictable by nature. Think about it this way. If predicting the market were truly possible, wouldn't every expert be a billionaire by now? The reality is, even the most experienced investors can't consistently call the market's short-term moves. So what does this mean for you as an investor? It means you shouldn't waste time trying to guess where the market is headed tomorrow, next week, or even next month. Instead, focus on the fundamentals. Invest in strong companies, think long-term, and avoid getting caught up in the noise of daily market fluctuations. Over time, the value of a company will reflect its ability to generate profits, not the short-term ups and downs of the market. The bottom line is this: the stock market is unpredictable in the short term, and no one, no matter how experienced, can consistently predict its movements. But that's okay. You don't need to predict the market to be a successful investor. Instead, focus on what you can control: your strategy, your discipline, and your long-term goals. That's how you build wealth with confidence. The reality is, no one can foresee future events or how the market will respond to them. The stock market is influenced by countless factors, many of which are unpredictable and beyond anyone's control. Here's the great news: don't need a crystal ball to succeed as an investor. Successful investing isn't about guessing what will happen next. It's about focusing on what you can control: your research, your strategy, and your discipline. By sticking to principles grounded in fundamentals, You can thrive in the market without the need for predictions. Let me share a personal lesson about the importance of staying disciplined and not blindly following expert predictions. When President Trump announced and imposed tariffs, there was a flood of expert opinions predicting economic doom. Headlines were everywhere, warning of trade wars, recessions, and skyrocketing prices. Some experts even projected massive GDP losses and significant hits to household incomes. Now, if I had acted on those predictions, if I had panicked and adjusted my portfolio based on the fear-driven narratives, I can confidently say my account performance would have suffered greatly. Why? Because those predictions were focused on short-term reactions and worst-case scenarios, not on the bigger picture or long-term fundamentals. The truth is, markets are incredibly complex, and no one can predict with certainty how they'll react to events. While the experts were busy forecasting disaster, I stayed focused on my strategy, analyzing the fundamentals of the companies I was invested in, and sticking to my long-term plan. And guess what? The market didn't collapse the way many had feared. In fact, my portfolio continued to perform strongly because I didn't let the noise dictate. Here's the key takeaway. Reacting to every prediction or headline can be counterproductive. The market is full of opinions, but successful investing requires discipline, patience, and a focus on what you can control. Predictions will come and go, but sticking to a sound strategy is what truly drives long-term success. So, the next time you're faced with a wave of expert opinions and news, remember this. No one has a crystal ball. Stay grounded, trust your process, and don't let fear or speculation derail your goals. As of 30th July 2025, one of my life accounts has achieved a 65.79% return year on year. To put that into perspective, the S&P 500 index, which is often considered the benchmark for the market, delivered a 19.16% return over the same period. Now, let's break this down. The S&P 500 is a widely respected index that tracks the performance of 500 of the largest publicly traded companies in the US. It's often used as a benchmark to measure how well an investment portfolio is performing. Historically, the S&P 500 has delivered an average annualized return of around 10% over the long term. A 19.16% return this year is already a strong performance for the index. But here's the key takeaway. Achieving 65.79% returns in a life account isn't about luck or speculation. It's about applying disciplined strategies, focusing on fundamentals, and staying consistent. While the S&P 500 represents the broader market, my approach involves identifying specific opportunities that align with my investment philosophy. Opportunities that can outperform the market while managing risk effectively. It's important to note that these results are not typical for every investor, and past performance doesn't guarantee future results. However, this comparison highlights the potential of a focused, well-executed strategy to deliver returns that significantly outpace the broader market. The bottom line is this. While the S&P 500 is a great benchmark, it's possible to achieve higher returns with the right approach, patience, and discipline. And that's what I aim to share, how to invest with purpose and clarity to achieve results that align with your financial goals. Let's talk about why stock prices go up and down, sometimes wildly on a daily basis. In the short term, stock prices are driven by one thing, demand and supply. If more people are buying a stock, the price goes up. If more people are selling, the price drops. Sounds simple, right? But here's the thing. Demand and supply aren't always based on logic. Often, emotions play a huge role. Fear, greed, excitement, panic. These emotions can cause prices to move in ways that feel completely irrational. A stock could be the exact same business today as it was yesterday, yet its price might swing 20%, 30%, or even 50% in either direction. There are other factors at play too, things like forced liquidation, where investors are forced to sell, algorithms and robot trading that react to patterns, ETFs moving large sums of money in and out of stocks, and even the market makers influencing prices. All of this create short-term volatility that often has little to do with the actual value of the business behind the stock. An insightful perspective comes from Warren Buffett, who famously said, "Be fearful when others are greedy, and greedy when others are fearful." This reminds us that the best opportunities often arise when the market is pessimistic and prices are undervalued. It's about having the patience and courage to act when others are hesitant. The lesson here is clear. The market's short-term movements are often irrational, driven by emotions and noise. But as investors, our focus should be on the long term, on the fundamentals of the businesses we invest in. By staying disciplined, avoiding the temptation to follow the crowd, we can position ourselves for success over time. Let's take a look at this chart of Microsoft stock, ticker symbol MSFT, during a particularly volatile period. This was when President Trump signed the executive order to impose tariffs on other countries. As you can see, the announcement had a significant impact on the stock market, and Microsoft was no exception. Initially, the stock price dropped by 25% over 17 weeks. This kind of reaction is typical when markets are hit with uncertainty. Investors were worried about the potential economic impact of the tariffs, how they might affect global trade, increase costs for businesses, and slow down growth. Fear and uncertainty drove the sell-off, and Microsoft's price reflected that sentiment. But here's the interesting part. After that initial drop, the stock rebounded sharply, climbing 61% in just 16 weeks. Why? Because markets often overreact in the short term. Once the dust settled, investors likely realized that Microsoft's fundamentals, its strong business model, diversified revenue streams, and leadership in key sectors like cloud computing remained intact. The rebound shows how quickly sentiment can shift when investors refocus on the long-term value of a company. This chart is a great example of how short-term market movements are often driven by emotions like fear and uncertainty, while long-term performance is tied to a company's fundamentals. If you had panicked and sold during the 25% drop, you would have missed out on the 61% recovery that followed. The key takeaway: don't let short-term noise or fear dictate your decisions. Focus on the bigger picture, stay disciplined, and trust in the long-term potential of strong companies like Microsoft, for example. Markets will always have ups and downs, but patience and perspective are what truly build wealth over time.